holding company, that if you bring each of these individual companies in and make them what a lot of people have heard the term wholly owned subsidiaries. So this corporation basically is owned by this one parent company that we're calling the holding company. And you do that with 3, 4, 5, 10, however many you want companies, that group now, aggregated together, has enough critical mass to justify going public, and that in fact you could set up a separate management team at the top whose sole responsibility is to deal with all the public issues, because that's another one of the barriers of why small companies don't go public, is that I can guarantee you, as a former CEO myself, that you've got a full-time job running this company all by itself. You take that company public and it's like you doubled your job. So it's a toughie for a CEO to manage all the issues related to being a public company, plus managing whatever business they're in, whatever product or service, etc. they're doing. So it's really doubling up the effort. In this scenario, we can have a dedicated team that focuses just on the public side of it, and then each of the CEOs and managers within those respective separate businesses continue to focus on running that. So that's at the core here, the idea of that you're aggregating enough so that you got enough critical mass to justify this whole group going public. You get a dedicated team that's running it, and that when you take it public, what happens is that all the people who own stock in these subsidiaries that get brought in, they exchange their stock for stock in the holding company. So when all gets said and done, the holding company picks up all the shares that are in the subsidiaries. It now gets those, and in turn, it gave its stock to all the shareholders in the individual companies. So now everybody owns the biggie all together. And that biggie goes public, and those shares either immediately or, with certain conditions over time, become freely tradable, and now you've got the answer for the liquidity for all parties in the equation. What it turns out, though, is that there's also a whole other big, huge benefit that results from this. One, in fact, two major benefits. One is that the value of the company, collective company, when it goes public, usually jumps considerably over what all the aggregate value as private companies, all those other separate companies were. And it comes back to that same liquidity question. The investor community says that if I'm going to put my money in this private company, I'm going to want a much bigger piece of it, because I can't freely sell this. So, if I'm going to take that risk, I want a bigger piece. And whereas if I buy stock in a public company, I know I can turn right around and sell it at any time. So I'm not going to demand as big a piece of that public company as I would for the private. Well, if you look historically across all the years that this has been going on, look at the industries, look at the different companies within the industries, that the rule of thumb that seems to pretty well hold consistently on the average, and some are much higher, some are much lower, but the average is that you could take the exact same company private, market at a certain value that, this is what the investment community would say, that company's worth that. And let's just throw out a figure, $10 million, just to put a number on it, just to explain this idea. That exact same company, if it were now public, would be ranked by the public on the average 5 times the private value. So in other words, it would be valued at $50 million. So there's a huge jump in value that occurs as a result of companies going from a private status to a public status. And a companion idea to that, that I just got through saying, the price that people are willing to pay for these shares is, in essence, they're willing to pay, say, 5 times as much for the same share piece of the company if it's public. We call that the cost of capital. And that's a key characteristic of public companies, is because of this whole liquidity question and the fact that it's easy for investors to be able to pull their money back out. Stock may have gone down, so they may have lost some, but they can at least sell it anytime they want typically. So the cost of capital for a public company is a whole lot lower than it is for private companies on the average. So as a result, you start off with this basic situation here where, let's say we've aggregated a number of these companies here, we've taken it public, we see this big jump in value. So not only my shares that I was holding before I couldn't sell, now they're worth a lot more than it was, and I can sell them. So clearly that's a very attractive thing for the investors. From the company standpoint, this lower cost of capital, the company, the overall company, can go back to the investor community, and either by doing things like a public offering, so they openly sell it to the public. That's what an IPO stands for, is initial public offering. Once you've done your initial, you could go back and do another one. You could say take a big block of stock and sell it to the public. They call those secondary offerings. So you could do that, or you could go and arrange to sell a big block of stock to one or two or a limited number of private investors on a private transaction. The company's allowed to do that. And then depending on the nature of the arrangements of the kind of stock that was sold to those people, they then now have the freedom to be able to sell those shares in the open marketplace. And this means that the company is able to go get capital both a lot less expensively and a whole lot easier than they can as a private company. So this means that if any of these subsidiaries need money for growth, to do technology development, whatever it might be, their cost of that capital and the difficulty of obtaining it is night and day difference from what it is as a private company. So that's one of the other key benefits that results from this.